indexes. Joining me now is William Huston, Chief Investment Officer at Bay Street Capital Holdings. Thanks so much for coming on the show. Pretty nice gains in the stock market. This has got to feel good for the bulls today, right?
For sure. Like you said about Moderna, it's part science, part art. So I think skilled investors right now are looking at the markets and people are coming to different outcomes. But today was definitely a day for people looking at the long game, expecting for a strong end of this quarter.
Yeah, so I know retail really in focus this week, William. I'm sure you have your eye on it as well, between retail sales data that we'll get on Wednesday, as well as earnings results from a lot of these retail companies. What's on your radar this week as we await those results?
So just like the jobs market, last week we were saying we were expecting that to come in strong. This week, I think that the sales are going to come in strong as well, but I think it needs to depend on which sectors that you're looking at. We've seen a shift in how people are spending that discretionary income. Travel is up 89% year to date. Airfare is up 44% year to date. And hotels are up 22% year to date. So I think for individuals that are looking to make decisions on that from an investment standpoint, you want to make sure that you're seeing how the consumer is shifting, because although inflation is up, despite that, there are some sectors that are still performing very well.
Why is the consumer, William, so important to the strength of the economy and thus the stock market?
Well, first, I think we want to look at consumer debt. In an inflationary environment, the first thing we want to see is how is this affecting the consumer first and foremost. And right now, consumer debt isn't out of control. Additionally, corporate debt relative to GDP, which would be the next thing I would want to look at, is also on trend. So I think that the consumer and how they're reacting to this in the short term is why it's so important, and why the markets are making a lot of these short-term tweaks. And also why we're seeing a lack of patience with some of these companies that have negative cash flows, because the market is nervous and making impulsive decisions. Yeah.
So certainly the data that we saw in July wasn't a one-off, for instance, in the sense that we had one positive data point. Pretty much all the data, William, that came in for July was very positive, after we had seen some disappointing data in June with those consumer prices rising at the fastest pace in 40 years at 9.1%. Do you think the lows in the stock market are behind us at this point?
In the short term, not necessarily. Again, I can see with a nervous market, people will make impulsive decisions. Now, for long-term investors, whether it's this week or 2 months from now that we hit a low, I don't think that that's going to be material in the long term. I do think the Fed has also become much more data dependent as opposed to on autopilot. And we've seen that they're going to continue to raise rates, but we're expecting a 50 basis points as opposed to 75. So all things are looking like they're trending positively.
That certainly is a positive. Some even expect that the Fed might start lowering interest rates next year. Are you in that camp? That would be a very positive move for the stock market.
I think it'd be hard to tell, to call that today, I guess you will say, because there is so much uncertainty around a lot of like how COVID is right now. We've got monkeypox, we've still got a supply chain issue. But I think the good news is that, again, overall, the economy is very strong. Overall, the jobs market is very strong. And so we've got this very weird situation where, on one hand, there's a lot of positive things going on, but on the other hand, there's a lot of hurdles that we've also got to get over. So it's hard to predict what's going to happen in the long term. But I will say I think the Fed will continue to be looking at this from a very data-driven standpoint and continue to be as vocal as they've been previously.
Well, we're toward the tail end of the second quarter reporting season, William. We've already started the third quarter, but retailers always the last to report. And again, as you and I have been discussing those retail results, they'll start to come in actually in earnest tomorrow morning when Walmart and Home Depot report. What's your view on the strength of corporate America? Is corporate America holding up?
I think so. And additionally, I think that even corporate America from the small business sector is doing very well. I'm in Atlanta right now. I had a meeting with the largest Black-owned commercial real estate company. And to my surprise, they were very excited about the future. Whereas I would say prior to that meeting, I still had a lot of concerns around the commercial real estate sector. But all that to say, yeah, I wouldn't say just, corporate like mega companies have been performing well and are starting to see some positive trends. But the good news is small businesses are also very excited about how they're positioned right now and how they're planning to move into the next couple of months.
So, as a chief investment officer, William, as a chief investment officer, what are you recommending that your clients do? Should they be dipping their toes back into this market, staying on the sidelines? What's the best path forward?
So from a peace of mind standpoint, there's nothing like a programmatic investing strategy. So that's why we speak so much about dollar cost averaging. You don't have to worry about if you time things appropriately. In terms of how the whole portfolio is allocated, again, we really think that the real estate sector is going to perform well over the long term. We like the luxury travel space. We think that COVID has permanently shifted how individuals are going to travel. We think they're going to be more interested in these private residences, the Airbnbs, the VRBOs, these private experiences because they've got apps to replace things like room service. They can just, DoorDash their food. They can DoorDash the massage. They don't necessarily have to go to the spa in a hotel environment where they're sharing a lot of resources. So I think long term, seeing how the behavior of the consumer is shifting is also going to end up playing well for investors that are trying to make a decision today.
Yeah. Well, it sounds like, William, and I think many people are in the same camp as you, that we could still see volatility ahead. That, yes, July certainly was positive data, but questions as to whether or not that was just a breather and a short term pause, or whether or not this economy is starting to turn around and get on a sturdier footing. So, to protect against any potential downside, are you recommending that investors buy commodities, anything to kind of take care of their portfolio in case we do retest these lows?
So what I would invest for investors, especially with how late we are into year, is not to make a rash decision. If you're trying to say, what should I do with my portfolio now? If you've not done something 6 months ago, 7 months ago, I would hang tight because, the market is going to reward you based on compound interest. So just compounding these good decisions, remain invested, buy the market now. Don't try to rebalance something prematurely, especially when we've seen a positive last couple of weeks. Just hang tight and realize that over the long term, instead of you trying to be so solely focused on what's going to happen tomorrow with said report, knowing that, hey, if you're invested in the long term, the market's doing fine, the indexes are going to be okay. And if you're looking for some outsized returns, allocating to something like real estate that's going to be less volatile and allow you to kind of take a breather and have some peace of mind on a day-to-day basis would be a good decision.
All right, William Huston, Chief Investment Officer of Bay Street Capital.